James was 32 years old. He had a good job, a solid savings account, and a Roth IRA he'd been quietly maxing out for 6 years. He thought he was doing everything right. He was. And then one afternoon, he needed $15,000 for an emergency. So he logged into his account, saw that he had over $70,000 sitting there, and transferred the money out. Simple. 3 months later, he got a letter from the IRS. He owed $4,700 in penalties and taxes on money he thought was completely his. He didn't cheat. He didn't break any laws. He just didn't know about a rule that almost nobody explains clearly, a rule that quietly controls every single Roth IRA in America. And by the end of this video, you'll know exactly what James didn't, so you never make the same mistake. Here's what most people believe about a Roth IRA. You put in money after taxes. It grows. You take it out in retirement, completely tax-free. The government never touches it again. That's mostly true. But inside that simple idea is a web of rules. Rules about income limits, contribution limits, timing, withdrawals, conversions. And if you get any one of them wrong, you hand a chunk of your retirement savings straight to the IRS. Most people know what a Roth IRA is. Almost nobody knows how to use it correctly. In 2026, the IRS raised the contribution limit to $7,500 per year or $8,600 if you're 50 or older. That sounds simple enough, but hiding behind that one number are income limits, 5-year rules, pro-rata traps, and excess contribution penalties that silently drain wealth from people who thought they were playing it safe. Today, we're going to go through 7 of the most dangerous Roth IRA mistakes, including the one that hit James. We'll look at exactly what they cost in real dollars. And at the end, I'll give you a clear 3-step framework to make sure your Roth IRA is working exactly the way it's supposed to. But first, the mistake that surprises people who've been doing everything else right. James discovered the Roth IRA at 26. A colleague mentioned it at lunch, said it was the closest thing to a legal tax cheat that actually works. James went home, researched it for 3 hours, and opened an account the next morning. For 6 years, he was disciplined. Every January, he maxed out his contribution. He invested in a simple index fund. He didn't touch it. He watched it grow from $7,000 to $71,400, a combination of his contributions and years of market growth. Then his car needed a $15,000 transmission repair. His emergency fund was only $8,000. He looked at his Roth IRA and thought, I put that money in myself. I already paid tax on it. I should be able to take it out. So he did. He withdrew $15,000. James was partially right and partially very wrong. That gap, that's what this entire video is about. Now, before we explain exactly what James got wrong, I need to tell you about the single most misunderstood concept in all of retirement investing. And it's something that will affect every person watching this video, whether they have $5,000 or $500,000 in a Roth IRA. There are not one, but 2 separate 5-year rules inside your Roth IRA, and they work completely differently. First mistake, not understanding the 5-year rule. Here's what James didn't know. Inside a Roth IRA, there are actually 2 separate 5-year clocks, and they control completely different things. Clock number 1, the contributions. Clock starts the moment you make your very first Roth IRA contribution ever. Once 5 tax years have passed and you're 59.5 years old, every single dollar your contributions and all your investment earnings comes out completely tax-free and penalty-free. That's the golden promise of the Roth IRA. Clock number 2, the conversion clock, is different. And this one catches people like James. If you ever convert money from a traditional IRA into a Roth IRA, that converted amount gets its own separate 5-year clock. Take it out before that clock expires while you're under 59 and half, and you owe a 10% early withdrawal penalty, even if your earnings clock has already run. James withdrew $15,000. About $9,200 of that was his original after-tax contributions. Fine, no penalty. But $5,800 was investment earnings. And since James was only 32 and hadn't cleared the 5-year rule with a qualifying event, that $5,800 was subject to ordinary income tax, plus a 10% penalty. Result, roughly $4,700 tax bill on a $15,000 withdrawal. More than 31% effective penalty on the earnings portion. Second, mistake contributing too much. In 2026, the IRS limits your Roth IRA contribution to $7,500 per year if you're under 50, or $8,600 if you're 50 or older. That total applies across all your IRAs combined, traditional and Roth together, not each combined. If you go over that limit, the IRS charges a 6% excise tax on the excess amount every single year. It sits there, not once, every year. If you put in $1,000 too much and leave it for 5 years, you've paid $300 in penalties on money you didn't even benefit from. The fix: remove excess contributions plus any earnings on them before the tax filing deadline. Problem solved, penalty avoided. Third, mistake earning too much to contribute directly. Most people don't realize the Roth IRA has an income limit. In 2026, if you earn more than $168,000 as a single filer, or more than $252,000 as a married couple, you are completely blocked from contributing directly to a Roth IRA. The phase-out begins at $153,000 for single filers and $242,000 for married couples. But here's the thing, being over the income limit doesn't mean you're locked out of Roth savings forever. There is a perfectly legal strategy called the Backdoor Roth IRA. You contribute to a traditional IRA, which has no income limit for contributions, and then convert that money to a Roth IRA. If done correctly, it's tax-free. One warning: the backdoor only works cleanly if you don't have other pre-tax IRA money. If you do, you hit the Pro-Rata Rule. Which brings us to mistake 4. Fourth mistake, the Pro-Rata Rule trap. The Pro-Rata Rule is, without question, the most confusing and most costly trap in all of Roth IRA planning. Here's how it works. Say you have $93,500 sitting in a pre-tax rollover IRA from an old job. You then contribute $7,500 to a traditional IRA planning to do the backdoor Roth conversion. Your total IRA balance is now about $101,000. When you convert that $7,500 to a Roth, the IRS looks at all of your IRA money, not just the $7,500 you just put in. They calculate what percentage of your total IRA is after tax. In this case, $7,500 out of $101,000 is only about 7.4%. When you convert $7,500, only 7.4% is tax-free. That's only $555. The tax bill on the other $6,945, at a 24% tax rate, that's a $1,667 surprise tax bill on a conversion you thought was tax-free. The fix is to roll your pre-tax IRA balance into a current 401k employer plan before doing the backdoor Roth. Many plans accept these rollovers. Once the pre-tax money is out of your IRA, the Pro-Rata Rule has nothing to grab, and your backdoor Roth is truly tax-free. And if you're watching this thinking, I don't make 6 figures, so this doesn't apply to me, hold on. Because mistake 5 hits everyone. Fifth, mistake treating your Roth IRA as a savings account. One of the most heartbreaking Roth IRA mistakes is not making a wrong move, it's making no move at all. Thousands of people open a Roth IRA, deposit money, and then leave it sitting in cash, or a money market fund, or whatever the brokerage defaulted them into. A Roth IRA is not a savings account. It is a tax shelter. The account itself doesn't grow your money. The investments inside it do. And here's what that actually means in real numbers. James, contributing $7,500 per year from age 26, investing in a broad market index fund averaging 8% growth, reaches $1,890,000 in tax-free retirement wealth by age 65. Same contributions, left in a cash account, earning 1%, $178,000. The difference? $1.7 million lost to inaction. Sixth Mistake waiting to open the account. Every year you delay opening a Roth IRA, that 5-year contribution clock doesn't start. Which means even when you finally do open it, you have to wait 5 years before your earnings become truly tax-free. The time cost of delay is invisible. You don't get a penalty notice in the mail. You just quietly lose years of tax-free compounding that you can never get back. Opening a Roth IRA at age 22 versus age 32, same contributions, same investments, the same 8% return, the cost of waiting just 10 years is approximately $820,000 in lost tax-free retirement wealth by age 65. Seventh, mistake, forgetting to file IRS. Form 8606. This one is quiet, boring even, but it is genuinely dangerous. Every time you make a non-deductible traditional IRA contribution as part of a backdoor Roth strategy, you must file IRS Form 8606 with your tax return. This form tracks your after-tax basis. It's the document that proves you already paid tax on that money and shouldn't be taxed again. If you forget to file it even once your records become muddled, years later, when you actually retire and withdraw money, the IRS may have no record of your after-tax basis. Result: you could be taxed on money you already paid tax on. Double taxation on your own money that you saved diligently for 30 years. The fix: file Form 8606 every single year you make a non-deductible contribution or do a Roth conversion. Keep copies forever or at least until 7 years after the account is fully withdrawn. After that $4,700 lesson at 32, James did something that most people don't do. He fixed it. He called a fee-only financial advisor, spent 90 minutes learning exactly how his Roth IRA worked, and never made another mistake. He kept contributing every year. He invested in a simple total market index fund. He filed Form 8606 faithfully every time he converted money. He never touched the account again until he was 62, well past all the 5-year clocks, well past 59 and a half. By 65, his Roth IRA balance was $1,340,000, tax-free. Every dollar. Withdrawals in retirement, $0 owed to the IRS, ever. The $4,700 mistake at 32, it was the best financial lesson James ever paid for. The Roth IRA is not complicated. It's just rarely explained completely, until now. Here's the insight. Most finance channels miss the Roth IRA doesn't punish you for being young, or for earning well, or for wanting access to your money. It punishes you for not knowing the rules. And once you know them, really know them, the Roth IRA becomes exactly what it was always promised to be: the most powerful tax-free retirement vehicle in America. 3 steps. Do these in this order. Step 1, easy. Open or verify your Roth IRA. If you don't have one, open one today. Pick any of the major brokerages: Fidelity, Vanguard, Schwab. Contribute at least something before the 15th of April, 2027 to count it for the 2026 tax year. Check what your money is invested in. If it says cash, money market, or settlement fund, that's a problem. Move it into a diversified index fund. The Vanguard Total Stock Market ETF or Fidelity Zero Total Market Index Fund are simple, low-cost starting points. Note the date you opened your account. This is day 1 of your 5-year contribution clock. Write it down, put it in your phone, remember it. Step 2, intermediate. Know your 2026 income limit. Single filer, if you earn under $153,000, you can fully contribute between $153K and $168K. Partial contribution. Over $168K, set up a backdoor Roth, but check the Pro-Rata Rule first. Set a calendar reminder to contribute in January. Contributing at the start of the year instead of the end gives your money an entire extra year of tax-free compounding. Over 30 years, that January habit is worth tens of thousands of extra dollars. File Form 8606 if you did any non-deductible contributions or conversions. Don't skip this. This form is your paper trail. It's the document that protects you from being double taxed years from now. Step 3, advanced. Consider a Roth conversion ladder if you plan to retire early. If you're aiming for financial independence before 59 and a half, a strategic Roth conversion ladder lets you access retirement money years early by converting traditional IRA funds to Roth in lower income years, then waiting 5 years for each tranche. Each conversion has its own 5-year clock. Plan accordingly. Explore a mega backdoor Roth through your 401k. If your employer plan allows after-tax contributions and in-plan Roth rollovers, you may be able to put an additional $46,000 into a Roth account on top of your regular $23,000 401k limit. This strategy is not for everyone, but for high earners who want maximum Roth exposure, it's a legitimate game changer. Consult a fee-only fiduciary financial advisor, not a commissioned advisor, not a friend of a friend who sells insurance products. A fee-only fiduciary who is legally required to act in your best interest. A 1-hour consultation can identify mistakes that cost you more than the fee in your very first year. James learned his lesson at 32. And because he did, he retired at 65 with $1.34 million in completely tax-free money. No IRS, no required minimum distributions, no clawbacks. Just decades of quiet, compound growth, protected from the government forever. That can be your story too. You just need to know the rules. If you know someone who has a Roth IRA or is thinking about opening one, send them this video. You might save them thousands of dollars. We break down the financial rules they never teach in school once a week in plain English. Hit subscribe so you don't miss the next one. Next week, we're tackling the 401k and the one employer match mistake that costs the average American $127,000 over their career. It's simpler than the Roth rules. And somehow even more people get it wrong. And right now, drop a comment below. Are you currently maxing out your Roth IRA? Just open one? Or is this the video that convinced you to finally start? I read every single reply.